In this video, we're going to go over an example using two different methods, the cost method followed by the equity method. And we're going to add in the new intercompany profit eliminating entries that we've just learned to our list of eliminating entries that we've already been working on. In this example, just to make our lives a little bit easier, there actually will not be any entries related to number 5 and number 6 on this list, but everything else we are going to see in this example. So let's head over to Excel. And so we have in this example, Peck Corporation owns 90% of the common stock of Siegel Company. The stock was purchased for $810,000 on January 1st of 2017 when Siegel Company's retained earnings were $150,000. Financial data for 2021 are presented on the worksheet. The January 1st, 2021 inventory of Peck Corporation includes $45,000 of profit recorded by Siegel Company on 2020 sales. During 2021, Siegel Company made intercompany sales of $300,000 with a markup of 20% of selling price. The ending inventory of Pack Corporation includes goods purchased in 2021 from Siegel Company for $75,000. The objective of this problem is to prepare the consolidated statements work paper for the year ended December 31st, 2021. So there's a lot going on here. The first thing we have to figure out is where we are in time. So we note that this first paragraph here is telling us all about the acquisition. And the acquisition happened on January 1st of 2017. But now they're asking us to fast forward a few years to December 31st, 2021 to actually prepare our financial statements. So we know from all of the problems we've done so far that the first thing we need to do, even though they're not asking us to do it, is put together our computation and allocation of differences schedule, which we have down here. So this first paragraph is historical information from the date of acquisition. So that's where we're going to look for that information. So our ownership percentage for this one is 90%. That leaves 10% for our non-controlling interest, and our total column has to be 100. Our purchase price in this case was $810,000. So we're going to take that $810,000 purchase price, divide by the 90%, and that gives us our implied value of our entity. Next thing we're going to do is we're going to take 10% of that implied value, and that's going to give us the value of our non-controlling shares. So now that we have our value of our non-controlling shares and our implied value, we need to compare that implied value to our total book value. And so this question's a little bit strange because they only told us about retained earnings on the date of acquisition. So we know that retained earnings on the date of acquisition were $150,000, but they don't tell us about any of the other equity accounts. And so what this problem is really leaning on is in our book and in this class, we are assuming that our subsidiary will never issue additional shares after the date of acquisition. And so that means if we have a current balance sheet, which we do over here on our worksheet, I'll make this a little bigger, then that means that we know how much common stock there was in our subsidiary on the date of acquisition because it doesn't change. So this is a $750,000. It's our only equity account besides retained earnings. So we're going to assume that that was also $750,000 on the date of acquisition. We're going to add these two guys up. And that gives us a total book value of $900,000. So we're going to take our implied value minus our book value. And that gives us a difference between implied and book of 0. So we also don't have any fair value adjustments in this example. And so that means that we also have a difference between implied and fair value of 0, which means we also don't have any goodwill. So this is why we don't have to do entries 5 and 6 on our list of eliminating entries because they've just simplified it for us by just making that not a thing. Okay. So now we've caught up, we've done this as of the date of acquisition, and so now we can fast forward to what they're actually asking us. And so they gave us all this information from the current year, and so I'm going to take a minute to organize that information to see what they've given us. So they told us that on January 1st of 2012, the inventory of the parent includes $45,000 of profit recorded by Siegel Company, the subsidiary, on 2020 sales. So what they're trying to tell us there is that we have 2020 unrealized profit. And let me just shorten this so it fits here. Unrealized profit, it still doesn't fit, of $45,000. And so these were sales by our subsidiary to our parent. So these were upstream sales. Then in the next part, they tell us during 2021, so that's the current year, Siegel Company, our subsidiary, made sales of $300,000. So we have 2021 intercompany sales of $300,000. And again, these were from our subsidiary to our parent, which makes them upstream. Those sales had a markup of 20% of selling price. Change that to a percentage. And so remember here, the terminology is really important because of selling means one thing and above cost means a totally different thing in terms of the calculation we're going to do later. So it's important to make sure you note that this is of selling. All right, then the ending inventory of Pack Corporation includes goods purchased in 2021 from Siegel Company for $75,000. So this is telling us that there's 2021 unsold inventory of $75,000. And again, this was related to upstream sales. Okay, so now we've got all that information ready. And so now we can go ahead and work on our actual eliminating entries. So let me see, just make another window here, see if that'll work. All right. Okay, so on the right-hand side of my screen, I've got all those notes we just made. And on the left-hand side of my screen, I've got our eliminating entries that we need to prepare. So we're going to start with the first one, that is eliminate any intercompany transactions, including current year dividends. And so this would be if we had any current year intercompany receivables, we would do that here. We're also going to, in these intercompany transactions, deal with that profit we just talked about on those sales, but we're not there quite yet. So the only thing we need to put in here is any current year dividends. So they didn't tell us anything about current year dividends. And so to figure out if we have any intercompany, we're going to head over to our worksheet. And we see on our worksheet that our subsidiary paid out dividends of $60,000. And so that means that 90% of those had to come to the parent, and therefore 90% of that 60,000 is intercompany. So when we're eliminating intercompany transactions, our credit is always to dividends declared by our subsidiary. The amount is going to be that 60,000 times our parent ownership percentage, which is 0.9 or 90%. And then the question becomes what our debit account should be. And so our debit account depends upon whether our parent is using the cost or the equity method. And so in this case, our parent is using the cost method. We can tell because that's actually up here in the name of the problem at the top. And also, if we look over here on our income statement, we see that we have dividend income by the parent, but we don't have equity income. So that's a pretty good clue as well. So we're going to eliminate these through that dividend income account and then move on to our next eliminating entry. So for the next eliminating entry, this is where we are going to eliminate any prior year intercompany profit. And so essentially what we're doing is we're saying that at the end of last year, there was inventory that was sold to intercompany and it hadn't yet left our consolidated entity. And so because of that, the inventory got marked up when it moved from our subsidiary to our parent. And we need to write it back down to its value when it entered our consolidated entity. So we did that at the end of last year. So here what we're going to do is we're going to make our beginning inventory match our write down for the end of last year. Because if we wrote down ending inventory, we now need to write down beginning inventory. Otherwise, there's going to be a mismatch in our numbers. So what we're going to do is we are going to credit 1/1 inventory on the income statement. And that's part of our calculation of cost of goods sold, because remember, our income statement is calculating cost of goods sold through the periodic method. And so our prior year unrealized profit is this $45,000 that they gave us. And so that's the amount that we need to write down inventory. Now, whether we use one debit account or two depends upon whether this is upstream or downstream. So in this case, these are upstream, which means it originated from the subsidiary. When it originates from the subsidiary, that means we have to give the non-controlling interest their share. So we're going to have to split this 90-20 between our parent and our non-controlling interest. So we're going to give our parent's ownership percentage, which in this case is 90%, to the parent, and we're going to take 10% and give it to our non-controlling interest. So the non-controlling interest always goes to 1-1 non-controlling interest. And then the question is, where do we put the parent share? And so the parent share, it's going to depend upon whether the parent used the cost or the equity method. In this case, our parent used the cost method. So the account is going to be 1-1 retained earnings of the parent. Our next eliminating entry is to eliminate any current year intercompany sales. And so we know that there were $300,000 of sales from our subsidiary to our parent. And so to make sales smaller, we're going to debit the sales account for $300,000. And we're going to, so this again, this is an intercompany transaction. We are getting rid of the sales by our subsidiary, and what we're going to get rid of by our parent is the purchases when they put this into cost of goods sold. Okay, purchases, cost of goods sold. And again, remember, this is part of that calculation of cost of goods sold on the face of our income statement. Now here, it doesn't matter whether this is upstream or downstream. It doesn't matter because it doesn't matter who made the sales and who made the purchases. At this point, we've already added the sales of both companies together. And so we're just decreasing that combined amount by 300,000 to take out that intercompany transaction. Same thing with purchases. Then when we get to the end of the year, we have some unsold inventory. So our subsidiary sold inventory to our parent, and our parent then sold most of it to somebody outside the consolidated entity, but they're still holding on to $75,000. And so the problem is that this $75,000 worth of inventory got marked up when it moved from our subsidiary to our parent. And so it's basically like we took $5 out of our pocket and out of our right pocket, and when we put it in our left pocket, it was worth $10. That doesn't make any sense. So we need to write this back down to its value to the subsidiary, so before it was transferred between entities. So the problem is, this is the value of the inventory. We need to figure out what the markup was. And so we haven't done that yet. And so we need to figure out what the 2021 unrealized profit is. And so the way we're going to do that in this case is pretty simple because our markup is 20% of selling. So the selling price was $75,000. 20% of that is going to be the markup, which is 15,000. So 15,000 is the amount we need to write our inventory back down. And so we're going to do that in two places. First, on our balance sheet. And so on our balance sheet, we know inventory has a normal debit balance. So to make it smaller, we are going to credit it. And we're going to credit it by 15,000. Then the other place we have to adjust this is in our cost of goods sold calculation. So we also have 1231 inventory on our income statement as part of the cost of goods sold calculation. So we need to make sure that these match, so we're going to have to adjust them both. All right, so now we're down to our investment income, and since we are not doing the equity method, this is NA. However, we are doing the cost method, so we do have to establish reciprocity. And so to establish reciprocity, we need to compare retained earnings as of the date of acquisition to retained earnings as of the beginning of the current financial period. So what we're comparing is the 150,000 that it was on the date of acquisition versus the 180,000 that it is at the beginning of this fiscal year. So since it increased, we're going to debit investment in S, and we're going to credit 1-1 retained earnings of the parent. Had it decreased, we would flip-flop our debit and our credit. Then we are going to calculate the amount, which is going to be the parent's ownership percentage, which is 90%. and it's going to be 90% of the difference between these two numbers. So I'm just going to type them in instead of linking them, but that's the $180,000 that we just saw on our statement of retained earnings minus the $150,000 that we saw on our CAD. So that's going to be $27,000. And then we can move on to our final eliminating entry, which is to eliminate our subsidiary equity. And so if you recall, we only had two subsidiary equity accounts. That was common stock, common stock, and 1-1 retained earnings. We don't have any difference between implied and book, but we do need to get rid of our investment in S. And we don't own 100%, so we need a 1-1 non-controlling interest. Common stock is going to stay the same because that's not a complication that we deal with over the course of our course. So if we look at our CAD, we have $750,000. That's the same $750,000 that's on the current balance sheet for our subsidiary. But when we get to 1-1 retained earnings, we already talked about the fact that that has increased over time. And so the $180,000 is the amount that we actually need to eliminate. Then since this number right here, the 1-1 retained earnings, has increased from $150,000 to $180,000, we need to take that extra $30,000 and allocate it across our credits, or this thing isn't going to balance. So we're going to take our original investment in S of $810,000, add to it 90% of the increase in retained earnings. So that's going to be that $180,000 minus the original $150,000. We're then going to do the same thing for the non-controlling interest. So we're going to start with the original $90,000. We're going to add to it 10% of that same increase. So the $180,000 minus $150,000. All right, so now we have all of our eliminating entries. We just need to go put them into our worksheet. So I'm going to reorganize here a little bit so that we can, so that we can see everything. And away we go. All right, so we are going to start with our dividend income. We are going to debit dividend income for $54,000. Then we are going to credit dividends declared by our subsidiary down on line 32 for the same amount. When we get to our next entry, we're going to start with a debit to 1-1 retained earnings of the parent on line 27. And we're going to debit for $40,500. Then we need to go down to non-controlling interest. And we're going to debit non-controlling interest for $4,500. Then we're going to head up to our income statement because this 1-1 inventory is part of our cost of goods sold calculation. So we're looking at the beginning inventory on line 14, and we're going to credit for $45,000. And so when I do this, the important thing to look at is the effect on total cost of goods sold on line 18, because that's where we're going to really understand what we're doing. And so currently we're at 1.8 million for our cost of goods sold. And so when we enter this, we see it goes down. And so remember, the cause of this was basically profit that we didn't let the entity count last year. And so this year we are going to let them do that. And so by decreasing cost of goods sold, that increases the profit margin and lets that profit be recognized this year. All right, then our next one is a debit to sales and a credit to purchases. Now, the interesting thing about this one is it's going to be an entry that corrects our sales line and our cost of goods sold line, but it's going to have no effect on the bottom line. So we're just trying to fix some inflated line items, but it doesn't actually affect net income. So we're going to debit sales for $300,000. And we're going to credit purchases for the same amount. And so what you should see is, again, our bottom line is exactly the same as it was before, but our sales number is smaller and our cost of goods sold number is smaller. Then finally, what we're going to do is we are going to write down our inventory that has not yet been sold outside our consolidated entity. And so we're going to start with the ending inventory on our income statement, which is line 17. We're going to debit for $15,000. And then we are going to also credit. We're going to credit inventory on our balance sheet on line 38 for the same amount. And so we see that our inventory got written back down to where it was before it switched from our subsidiary column to our parent column. All right, we don't do anything for number 2. For number 3, we are going to debit investment in S on line 39 for $27,000. And then we're going to credit 1/1 retained earnings of the parent on line 27 for $27,000. And then finally, we have our entry to eliminate our subsidiary equity. So we're going to start with common stock of our subsidiary down on line 47. We're going to debit for $750,000. Then we have to do 1/1 retained earnings of our subsidiary up on our retained earnings statement. We're going to debit again for this time for $180,000. And then we're going to switch to our credits. Our first credit is going to be on line 39 for investment in S. And our final entry will be to 1/1 non-controlling interest on line 49 for $93,000. So we're not quite done yet. We've entered all our entries, but we still need to calculate our non-controlling interest in net income. So to do that, we're going to head back over to our worksheet over here, and we have the schedule that we haven't yet filled out. So we're going to start by taking net income as reported by our subsidiary, which is $71,250. Now, if we had fair value adjustments, we would also need to consider whether we need to make adjustments to this amount due to those fair value adjustments, things like extra depreciation, extra cost of goods sold, or goodwill impairment. In this example, we don't have any fair value adjustments, so we're going to skip that. We do, however, have upstream income or upstream unrealized profit. And so we do need to make an adjustment for that. And so in our question here, we saw that we had prior year, let's see where I have it. We have prior year unrealized profit upstream of $45,000. So last year we didn't let them recognize it. This year they are going to recognize it. So we're going to put it in there. But then at the end of this year, we had $15,000 that we said they couldn't recognize yet. So we're going to take that out and we'll let them recognize that next year. All right. So now we're going to go ahead and sum this up. And that gives us our adjusted subsidiary income of $101,250. Our non-controlling ownership percentage is 10%. So 10% of this amount is $10,125. And that's the amount we're going to put on our income statement. Now, the rest of this we don't actually need, but what we can do is we can use this to double check our consolidated interest in net income, or this bottom right-hand corner of our income statement. So our parent ownership percentage is 90%. We're going to give them their share. In this example, we don't have any downstream sales, so we don't have any prior year or current year unrealized profit from downstream sales. So we don't need to make any adjustments there. If we were doing the equity method, this would be the amount of equity method income that we would have recognized and would need to be eliminated. But we're not. So what we're going to do now is we're going to take this amount and we're going to add to it our parent net income from its own operations. So we're going to take what our parent recorded, which is $103,500, and then we need to subtract out the income it recognized from our subsidiary. In this case, because they were using the cost method, that income was the $54,000 of dividend income. We're going to take that out, sum this up, and that gives us our same number that we have here in the bottom right-hand corner, the $140,625. Okay, so I'm just going to make this a little bit bigger here for a minute so you can see the whole thing. It's going to let me. And so if you take a look here, we see that we have remembered to do our non-controlling interest in net income. We have our statement of retained earnings here, where the only dividends that remain for the consolidated entity are our parent's dividends. We see that the subsidiary dividends either get eliminated or go to that non-controlling interest. On our balance sheet, we see that our investment in S is fully eliminated and it balances. We've also gotten rid of all of our subsidiary equity, so we're feeling pretty good about this consolidation. So now what we can do is we can move on to the next year. If we go back to our PowerPoint, you'll see we're not really doing anything differently. We're just going to apply the equity method this time. So we're going to start the same problem all over again, but we're just going to use the equity method instead of the cost method, or we're assuming that our parent used the equity method instead of the cost method. And so on the right-hand side here, I'm putting up the problem we just did just because we have this information here, so I don't have to redo it again. But everything is exactly the same, except we're assuming our parent used the equity method. And so you'll see our CAD is already here. Why is it already here? Because we prepare that on the date of acquisition before our parent has to even decide if they're going to use the cost or the equity method. So that's going to stay the same. So then what we can do is we can jump right into our eliminating entries. And so if you'll recall from the previous example, our credit account is always going to be for eliminating current year dividends is always going to be dividends declared by our subsidiary. And again, if we look over on our worksheet, this is where we can see that our subsidiary declared dividends of $60,000. And so $60,000 is the total dividends declared. Of that, 90% would have come to us as the parent. So 90% is the portion that needs to be eliminated. Now, thing that's going to change here is under the equity method, our parent would not have recorded these as dividend income. Instead, they would have recorded it as an adjustment to investment in S. And so that's where it needs to be eliminated. On our next entry, this is where we are going to eliminate any prior year intercompany profit. We're going to make that adjustment. And so just like in the previous example, we are going to start by writing down our beginning balance of inventory on our income statement. And so we would have written down the ending balance at the end of last year. We need to write down the beginning balance to make it match. And so this is going to be for that prior year upstream unrealized profit. And then remember, we said that when it's upstream, it's originating from the subsidiary. And so we need to give the non-controlling interest their share. So we're going to take 90% and give it to the parent. And we're going to take 10% and give it to the non-controlling interest. Non-controlling interest share always goes to 1-1 non-controlling interest, but the parent share, it's going to depend on whether the parent used the cost or the equity method. So last time we used the cost method. This time we're assuming the parent used the equity method, so this account is going to change to investment in S. Now, if this had been downstream, the change that would need to be made in both cases is we would get rid of the non-controlling interest. So the entire thing, the entire 45,000 would go to the parent account if this had been a downstream sale. All right, so in the current year, we still have $300,000 of intercompany sales, and we're going to eliminate this exactly the same as we did when our parent was using the cost method. So there's no change here based on cost versus equity, and there's no change here based on upstream versus downstream. So we're going to debit sales, and we're going to credit purchases in cost of goods sold. And that's going to be for the full amount of those sales, which was the 300,000. And then finally, we are going to write down our inventory that is unsold. So the inventory that moved from our subsidiary to our parent, but has not yet been sold to an outside entity, we're going to write that back down to its value when our subsidiary purchased it. And so again, this one doesn't matter if the parent uses the cost versus the equity method. It doesn't matter if it's upstream or downstream. Every single time, we're going to write down inventory on our balance sheet and also where it appears on our income statement in that calculation of cost of goods sold. And the amount is going to be that unrealized profit. So again, the amount that it was marked up when it moved from our subsidiary's inventory to our parent's inventory. Okay, so number two, we skipped last time because we weren't doing the equity method. This time we are doing the equity method. I'm going to pop back over on the right to the actual problem we're doing because you'll see that most of this worksheet that we did before has pre-populated. So all of this part is the same whether the parent used the cost or the equity method. It's just this last little bit that changes. So that part hasn't populated. But the calculation of the non-controlling interest in net income and the calculation of the equity method income are the same. So we've actually already calculated the equity method income, but if we had been doing this problem from scratch, this is when we would have needed to calculate all of this to figure out what the equity method income that our parent recorded was. I mean, if we're feeling daring, we could also just go to look at the worksheet and hope that it was their only equity method investment because that is the same number, but the better way to do it would be to calculate it on our own. So for this entry, we are going to debit equity in S income and credit investment in S. And then again, that amount is going to be the $91,125. Next, we established reciprocity previously. We don't need to do that because this is not a cost method question, so that is not applicable. And then finally, we need to eliminate our subsidiary equity. This one is going to be identical to the last time. So we're going to debit common stock of S, 1 retained earnings of our subsidiary. We're going to credit investment in S and 1 non-controlling interest. As we saw previously, common stock is still going to match our CAD. 1 retained earnings is not. So we're going to go peek over on our worksheet and we see that it's $180,000. And so again, because the $180,000 has increased from what it was on the date of acquisition, which is the 150, we're going to need to allocate that $30,000 between our credits to make this thing still balance. So we're going to take our $810,000, we're going to add to it 90% times the difference between this 180,000 and the original 150,000. Then for our non-controlling interest, we're going to take 90,000, add to it 10% times that same difference, which is 180,000 minus 150,000. Okay, so now we have all of our eliminating entries and we can go ahead and put them into our worksheet. We're almost there. All right, line up a little better. Okay, so we got a new worksheet, and our new worksheet is going to have a new trial balance for our parent because in this case, our parent is using the equity method instead of the cost method. Subsidiaries, trial balance should be exactly the same. We're going to go ahead and enter in our eliminating entries. So for this one, we're going to start with investment in S. Notice that we're going to have a few debits and credits to our investment in S. So anything that's on either line 41 or 42 is going to come into our investment in S total in column I. So we're going to start on line 41 and we are going to debit for $54,000. Then dividends declared by our subsidiary is up on line 32, and we are going to credit for $54,000. Then for our next entry, we're going to go back to investment in S. We already debited it once on line 41, so we're going to move to line 42, and we're going to debit for $40,500. And then we're going to head down to non-controlling interest on line 52. And we are going to debit for 4,500. Then our credit is going to be up on the income statement. So we're going to head back up to 1-1 or beginning balance of inventory on line 13. And we are going to credit for $45,000. Next, we're going to debit sales for 300,000. And we're going to credit purchases on line 14, also for 300,000. Next, we're going to look at the ending balance of inventory on line 16. So again, that's the one on the income statement. And we are going to debit for 15,000. And then we're going to head down to the inventory on our balance sheet, and we're going to credit also for 15,000. Next, we're going to eliminate our equity income, which is on line 10. So we are going to debit for $91,125. Then we're going to head back down to investment in S, and this time we're going to credit investment in S on line 41 for $91,125. We don't have to establish reciprocity for this one, so last thing we have to do is eliminate our subsidiary equity. So common stock of our subsidiary is on line 50. We're going to debit for $750,000. Then 1-1 retained earnings of our subsidiary is up on line 27. We're going to debit for $180,000. Then we head back down to investment in S. This is our second second credit for investment in S. So that's going to be on line 42 for $837,000. And then finally, we're going to credit non-controlling interest on line 52 for $93,000. All right, so we are not quite done yet because we have to fill in our non-controlling interest amount. That's going to be exactly the same as what we calculated on the last problem. And so we're going to go ahead and grab that $10,125. And then the only thing we have left to do, our worksheet is done, but just to be thorough, we're going to confirm this bottom right-hand corner of our consolidated income statement. And we're going to do so by taking our parents' reported income of $140,625 and subtracting out the income that we recognized from our subsidiary. In this case, because it's the equity method, the income was the $91,125 of equity in subsidiary income. We're going to take that out, and you see that we end up with exactly the same amount of equity income and exactly the same amount of parent income from operations. And when we add them together, we end up with the exact same consolidated income, consolidated interest in consolidated net income, which we should. So this number is the same as it was in the previous example, just calculated in a different way. All right, so that wraps our final problem for this module.